Canada has just set a record, but not the kind you want to celebrate. In the second quarter of 2025, our current account deficit, basically the scorecard for money flowing in and out of the country, hit minus negative $21 billion. That's the biggest shortfall in our history. But here's the scary part. This isn't just about an economic headline. It's about jobs, trade, and the Canadian dollar in your wallet and the investments you are relying on for your future. So today, let's break this down in plain and simple English. What does a record deficit mean for Canada? Why are exports crashing? And most importantly, how should you think about your money in this environment? All right, so let's start with the basic. The current account is like Canada's checkbook with the rest of the world. It tracks, number one, goods and services we sell to other countries, which means exports. Number two, goods and services we buy, which we call them imports. And number three, money coming in from investment abroad. And number four, the money flowing out when foreign investors take profits from here. Now, if we export more than we import, we are in surplus. That means money is flowing into Canada on net. If we import more than we export, we are in deficit, which means on net, money is leaving Canada. In Q2, the gap was so large that for every dollar flowing in, way more dollars were flowing out to the tune of $21 billion in just 3 months. So what is driving this? Number one, exports dropped 13.1%, mainly to the US because of the tariffs, our biggest customer. Think about that. If you run a small business and your biggest client suddenly cuts orders, your income collapses. That's what just happened to Canada, but at a national level. On top of that, the global demand is cooling because the global economy is literally in recession. Tariffs and trade barriers are making it harder for Canadian goods to compete. And the strong US economy compared to Canada means our dollar looks weaker and making imports more expensive. And finally, capital is fleeing. Investors are pulling money out of Canada because growth looks weak and they see better opportunities elsewhere. Here is where it gets real. When Canada runs big deficits, the government and businesses often need to borrow more from abroad. That puts pressure on the Canadian dollar. If the loonie falls further, everything we import, food, fuel, technology, travel, becomes more expensive. At the same time, Bank of Canada is stuck in the corner. They are already signaling rate cuts, waiting for US to take the step. Not because inflation is gone, but because the economy is breaking down. Lower rates might help borrowers in the short term, but they also make the dollar weaker and risk stoking inflation again. It's like trying to put out a fire with a leaky bucket. Now, if you're thinking this is all overwhelming, I don't know how to navigate it, that's exactly why I built my macro fundamental course. I take complex ideas like trade deficits, currency moves, central bank decisions, and break them down step by step. By the end, you will actually understand what's driving the markets instead of just reacting to the headlines. The link in the description below if you want to join. And if you're ready to take action, I have partnered with Webull. Sign up with my referral link in the description and you will get $50 in free stocks plus 2% deposit match to kickstart your portfolio. Don't wait until the system tells you what to do. Take control now. So here's the bigger picture. Canada's economy is slowing. Then our trade balance is collapsing and the investors are taking their money elsewhere. This is not just a blip. It's a sign that Canada's growth model, relying heavily on trade with the US and foreign investments, is under serious stress. As an investor, you need to decide, do I stay all in on Canadian assets and hope things turn around, or do I diversify, protect my portfolio, and position myself where growth and capital are actually moving? This is why I always say markets do not lie. Money flows where it is treated best. And right now, the money is flowing out of Canada. So here is my question to you. Do you think the Bank of Canada cutting rates will save the economy, or just make the dollar weaker and life more expensive for Canadians? Drop your thoughts in the comments. I would love to hear your perspective. And if you found this breakdown helpful, make sure to hit like, subscribe to the channel, and share this video with someone who needs to see what's actually happening behind the headlines. Because at the end of the day, understanding the game is the only way to play it well. See you in the next one. Sorry for the interruption, guys. Just wanted to let you know that I also offer one-on-one consulting calls to the individuals who are looking to discuss their financial planning, their investment strategies, their kids' education planning, their immigration moves, as well as the young professionals, because I have been in the tech industry for almost 20 years. So I also offer one-on-one consulting calls to the young professionals who are looking to have their career development discussion with me, and also personal branding as well. So if you are looking to have some sort of an expert opinion, there is a calendar link in the description below. Book a 30 minutes call with me and I will be more than happy to help you out.